How are you both?
Well, Chris, how are you?
Yeah, no complaints.
Shane?
G'day Andrew, Chris. Nice to be back here again, talking about fun stuff.
Yeah, definitely. It's been another interesting month. Shane and I last time we had a chat and we're like, things are jumping around and we've seen another month of it. So yeah, it's interesting.
Yeah, the data, we just can't seem to get enough data, can we? The world's thirsty for it, and every time it comes out, the markets react positively
absolutely.
or negatively, depending.
Yeah, correct. Yep. All right, well, let's get into it. GDP growth.
Yeah, I mean, this has been a touchy one, hasn't it? Inflation's sort of at core, and we'll go through that, but GDP growth has been slowing, but it's holding on. I'm quite surprised how resilient the economies have been, and I'm sure we'll talk to interest rates through today, but this chart again speaks to it a bit, doesn't it? The GDP's, it's hanging in there.
Yeah, it is. Like all the other indicators as well. So unemployment's still quite low, and so I guess we're all waiting for the really bad economic news to come. But I guess we've been saying that for a while now, and the indicators have been holding up.
I heard this morning on a podcast that Europe are expecting to head into a recession later this year. They've been there, and they're sort of heading down the path of paying 2 to 3 times energy price what the rest of the world is paying right now. So, maybe some of that stuff will start to flow through world GDP. But looking here in Australia, similar story, right?
Yeah, absolutely. So it's as I both said, holding up okay, which is good for now, until we start to see that tide turn, I suppose. Well, if it turns. Bit of, updated inflation data from last month. The US graph hasn't changed because they haven't reported, but we had our last quarterly inflation read here in Australia, coming in at 5.4%, whereas the quarter before we were at 6%.
Yeah, I mean, inflation number headline trending down, but I think behind the detail there is above expectation, and hence Reserve Bank have responded pretty swiftly this month, right?
Yeah, well, and I think it's the composition within that inflation number. So the commentary centred around goods inflation coming off a little bit, but services inflation being a little bit stickier.
Yeah, interestingly, and sort of speaks to the wage price index chart that's up currently. That as you can see, if you go back a slide, we can see the inflation numbers coming down from say the end of last year slowly, but we've still got wage prices only just having peaked.
Yeah, and the narrative is still specifically to this point, and your comment there, Andrew, is spot on. I think insofar as and we talk about this every month, is that wages have been rising but sticking, and it's kind of contributing heavily to inflation. And yesterday during investment committee we sort of talked about this a little bit, right, in terms of wage stickiness, and there's no real simple solution to fix that, right? It's without casting forward the crystal ball, like it really does need to see unemployment rise, is what the RBA want to see. Which sort of pains me in a way, because with unemployment rises, there's pain being inflicted on households.
Yeah, it's a dilemma, isn't it? It's one of those parts of economic theory where you kind of can't please everybody in some sense, is that there'll be some hurt along the way. I guess you just hope we don't break too much too quickly.
Yeah,
and how bad it is and how sustained it might be.
Yeah, absolutely. And I think in terms of the discussion, Shane, around what's happening in Europe at the moment, and there's the charts that are up at the moment, just in terms of the comparison of Australian interest rates versus the rest of the world, and where we are actually lagging, by around half to almost 1% in terms of where we are now. So that kind of speaks to some of the slides earlier where it shows you that the RBA started raising later than the rest of the world, and we're kind of a little bit, I guess, behind the curve in some context, whereas it's looking like now Australia is kind of, well, you wouldn't necessarily say out of step, but there's a risk that I guess we're raising into an environment that where the rest of the world is holding or cutting rates?
Yeah, there's been a lot of discussion as of yesterday, 2 days ago, Melbourne Cup Day, interest rate rise after sitting idle for 3 or 4 months prior. And the only thing I would sort of add in that regard is I was somewhat pleased that the Reserve Bank this time around did actually hold fire and waited for some further data to come through. And I think when you look at it and saw inflation was higher than expected, to me it felt like a sensible move, albeit difficult in many parts of the economy. And fascinatingly, the equity markets have been positive on the back of a rate rise, which is kind of like it's so unusual how the market's reacting to this information, but it seems like the market's given a tick of endorsement that it was a good call to make on Tuesday.
Yeah, it's interesting, isn't it, where we're in that environment where market expectations, Reserve Bank does what it wants, great, we'll react positively, and it's almost like like rather than political pressure, a bit of like market pressure in terms of there's quite a few forces going on that's making things difficult at the moment.
Yeah, and I think it's sort of now we're at that point where I feel as though rates have risen 13 times since we commenced raising, and we've got to remember a couple of those raises were also double raises early in the piece too, right? So we've had a significant crank in interest rates. The estimated or expected time frame or delay for full impact of a rate rise to be felt is 18 months. So, if you just apply that simple logic, it probably suggests that next year we're going to be looking at kind of some tougher, economic conditions, dare I say it.
Yeah,
not necessarily equity markets, but economy, like at the coalface of the economy.
Which then probably supports this, or is supported by this next chart here, where the savings rate has taken a sharp decline. So it's presumably it's those carrying a little bit of debt eating into the savings that they may have built up over a period of time. And the chart above that, which shows your consumption has also taken a hit as well. So it all points to some tough times ahead, I think.
Yeah, interestingly here, I think that maybe some of the reason for the stickiness here is that, coming out of COVID, we did have such high savings ratios because I guess we all experienced it, right? No one was really going anywhere. And for those that weren't impacted in terms of their employment situation and were able to make the switch, building up the savings was relatively rapid. And then so, to your point, Shane, about the lag effect, probably haven't felt some of those initial interest rate rises that you normally would in that 18-month period because you've just been able to absorb it with the high savings rates. So
yeah, and also to the factor of fixed rates sort of progressively rolling off more and more so now too, right?
Yep.
But I agree with you entirely. I mean, that's the anomaly here is that it's masking kind of some of the reality of the situation, and it's also I can't recall what the total number was off the top of my head, but the stimulus that was given through COVID, it's still kind of speaking to these charts now. The JobKeeper, JobSeeker, the business stimulus payments that were significant in size. So without sort of being doomsdayers, I think it's certainly it's a reality that we're looking at today is that savings rates are masking kind of the rate rises, and I think certainly we're likely to see volatility in the economy in the next 6 to 12 months.
Yep. And again, to your point before, Shane, it's data dependent, right? So the RBA are going to be led by that rather than trying to jumping at shadows. They've got to make decisions as that comes through, but it feels like in the next probably 3 to 6 months that probably going to have some more data that deals with some of these they're not emerging issues, but issues that are showing signs of coming out a bit clearer.
Certainly in a related context, I was looking at CBA put out a household spending report each month, and I was looking at that earlier. An observation from that, they separate out essential spend with discretionary spend, and for the 12 months to September, the rate of growth in essential spend was double that of discretionary.
Yeah, wow.
So I guess highlighting that discretionary is starting to slow down.
Yeah. And we're being forced to spend more on essentials.
Yeah, yeah,
It's amazing. I know, speaking anecdotally from my house, the cost of little people to eat food is extraordinary.
Oh, yeah.
And that's, we're all feeling it, right? It's like you don't have a choice whether you eat.
Yep.
Yeah, correct.
So put food on the table.
Yeah, that's right.
Yeah.
Yeah, I might use that as a bit of a leverage tool at some stage.
It's interesting. That's probably a good one to have in the next chart pack, Andrew, I think, because, that's something to keep an eye on, which is good. So that kind of, I guess, is feeding into this chart for those who watched last month and have, I guess, been back earlier in the year, a bit of a place on what the potential options or scenarios that, we looked like we may have. And this was probably back in, was it May-ish this year that we kind of started working with this?
Yeah.
Just to sort of see, the three range of outcomes and balance of probability across the three of them. And having, as Shane said before, we had our investment committee yesterday, it's becoming a bit clearer, with sort of where we're headed. So do you guys want to sort of run through that?
Yeah, certainly a lot of the commentary is centred around perhaps hopefully trying to avoid a major recession, I guess is the impacts from the RBA and their continued influence around trying to control inflation. So I think scenario B, at the risk of, forecasting what might happen, but I think scenario B, bit of what's called macro volatility. So, and that whole point, and it's the commentary's been there for a couple of months now around inflation being sticky or stickier and maintaining then the interest rates and the environment that goes with trying to control inflation, the notion around higher for longer, and that's supported by the interest rate forecast on the earlier slide where forecast suggests that central banks will hold interest rates at these elevated levels for a period of time. So I think that all points potentially to a hopefully not a deeper, a major recession, but maybe just more of that volatility in the short term.
Yeah, any thoughts, Shane?
Yeah, look, I agree entirely, and to echo your sentiment there, I think what we're seeing today is exactly that, right? Macro volatility. I mean, we'll see the data in a second for what the equity market returns and bond market returns have been like over the last little while, but it's been frightening again, right? The last month or so, equity markets trending down, bond markets been troublesome, speaks exactly to that kind of case B, or seeing macro volatility and the data dependency we talked about earlier. It comes out positive data, equity markets rally a little bit, looks a bit shaky, stronger for longer, and interest rates has been certainly notable, and all of a sudden equity markets fall, and it feels like it's kind of, we're back in the coalface of chaos once again.
Yep.
But we turned November, and now here we are on the 9th of November today recording, and it's equity markets had a good week, and it's amazing how short-term returns have become kind of, when you've got such a high amount of volatility, a short-term return becomes something we take note of.
Yeah, absolutely, and I think that's like even more important in the bond market, where we shouldn't expect the amount of volatility typically through through history, that the amount of volatility that there has been in the last 18 months even, I guess, is remarkable. Like, I just look at that uptick in return over the course of a month. Like, you're looking at, what is that, -5 to like a 2% differential in a week inside bond. It's so, the moves are so big.
And even interesting to that point, last night I was just on the NAB Morning Call podcast this morning. Bond yields notably came off last night quite significantly after rate rises, and it sort of almost feels as though the market is now pricing what's fully aware macro volatility is there. Market's pricing that in heavily now, as we've seen in share markets trending down, and bond market yields coming off on the 10-year basis implies that perhaps we're looking closer to having to retreat from where we've been if things get a bit hairier over the next little while.
Yeah, absolutely.
So that was interesting because it wasn't just in the US, it was across the board.
Across the board. Yep.
Yeah.
Yeah, there's definitely seems to be less about the rate rise itself, more about what does it mean for 3 to 5 years time.
Yeah. Agreed.
And then obviously equity market performance, that differential, I suppose, over the last 12 months continues to hold, where Australia is significantly underperforming the rest of the world.
Yeah, and and even I just marvel at the volatility in that chart, right? I mean, it's it's difficult for investors to kind of work through that, and it's be nice to wake up when it's all finished and just sort of go, how did I go? But the emotional roller coaster that goes with all this is apparent. But yeah, certainly Australia being very resource heavy and banking heavy is certainly notable in our returns.
Yeah.
But it does point to the rhetoric that we bang on about all the time around it's a long game, so it's very easy to
Good
get
segue,
distracted and drawn into what's going on in the short term, and but yeah, it's a long game, and don't get too sort of distracted by the short term volatility, because history shows it happens all the time.
Yeah, absolutely.
And I think even to that point, I mean, one thing that's always worth reflecting on and noting today is that whilst volatility is present, for a lot of deposit holders or cash holders today, we're now obviously seeing some pretty healthy term deposit rates, and I dare say by next week we'll probably see mid-fives in term deposits. There's I guess counteracting facts that are at play here, which allows us to kind of work through that volatility a little bit, I wouldn't say more comfortably, but we can tolerate it a little bit better when we've got higher cash rates than what we've seen over the last sort of decade. So
it gives you another tool in the belt to be able to pull the lever on if you need to.
Yeah, and there's something very comforting about seeing portfolios with who are in a need for a term deposit, having a 5% plus term deposit in a portfolio. It kind of, you smile and think, well, that's a nice position to have as an anchor in a portfolio where appropriate today.
Yeah, compared to 18 months ago.
Yeah, that's right. You've got 0.1 and you're like, oh, that's good.
Yeah, well, it's like I go back and think, well, maybe even sort of further back than 18 months, like maybe like 3 or 4 years ago. It's been a long run now where to think about use of term deposits in a portfolio hasn't been as common, I think, for a long time. It's great.
Yeah, your role to play now.
Yeah, absolutely.
And the last thing I was going to say on volatility here, I think is or the long game, Andrew, I think you're absolutely spot on, is particularly bond holders. This kind of notion of term deposits, and it feels like an obvious home for bond money to come out of fixed income and go back into term deposit because it's safe and it's comfortable and we're finding the high ground.
Yep.
But quite often when, that point of the tide is turning, we make that decision to go to a spot where we probably shouldn't.
Yep.
And bonds, arguably, if you kind of look at the narrative around the world, is that inflation feels as though it's peaked, and we're seeing data show that it's come down. Interest rate cycle may very well too have peaked, if not close to it. And then if we do have economic difficulty and the possibility of rate cuts in the next 12 to 24 months, the bond markets are the place that's going to win out of that. And as you saw that last month, that simple shift in expectation pushed bond prices, or pushed returns in bonds back up quite healthily in a very short period of time. So I just felt we often talk about equities in the long game. I think in this instance, bonds are also a very healthy place for a long game to be considered.
It's probably worth going back and seeing the September market update for, I guess, a more detailed run through of that, because I know, Shane, you went through a relatively comprehensive discussion on this point, but going back to that slide from this one here, just in the November chart there, that's exactly what Shane's just talked about, is exactly the dynamic that I guess we're discussing. And so the last few years has been painful for bondholders, and now's almost the worst time to get out.
And on a relative basis, you're yielding between 4 and 5% on bonds typically, and capital upside now is a possibility because we've felt the downside with rates rising so heavily. Anything that goes the other way, or even expectation goes the other way, we're going to see some capital appreciation in that space. So, as difficult as it's been, I really feel as though most people we work with have been quite content to hold their bonds, but I think it's always an important aspect just to unfortunately consider the volatility we've had to live through in the bond market.
Yeah. Excellent. All right, I think that's all we've got time for today, gents.
Yeah.
Anything else you wanted to add?
How was your cup week been for you, Chris? Tuesday?
Yeah, it was okay. Yeah, it was relaxed, which was good. So time with the family, which was much needed, and the weather was magnificent, so that helped.
Cracker of a day.
Yep.
Yeah. You, Shane?
Well, it was okay. I love Spring Carnival, but my $2 betting per race hasn't served me too well on Cup Day, so I won't increase the stakes.
You'll never be a big winner, but you'll never be a big loser.
Exactly right.
Yeah.
But you know what? The last thing I was going to say is it's quite amazing. Next time we're sitting here is December, Christmas edition.
It's going to be crazy.
So yeah, crazy season's upon us.
Yeah.
So
Yeah, absolutely.
Oh, till next time, everyone. Have a good month.
Thanks.
thanks, gents. Bye for now.